When most people hear the word bonds, their brain shuts off. It sounds boring. It sounds complicated. It sounds like something only bankers and governments should care about. But here's what almost no one tells you. There's a market bigger than stocks, worth over $100 trillion, and it quietly decides your mortgage rate, your job security, your investments, and it even affects how risky something like Bitcoin feels. That market is the bond market, and once you understand what bonds actually are, a lot of confusing things suddenly become very simple. Interest rates start to make sense, and so do sudden jumps in mortgage costs. You understand why stocks struggle when yields rise, and why governments care so much about inflation. All of it runs through bonds. So let's strip this all the way down and rebuild it from scratch. A bond might sound complex, but it's actually very simple. Once you see it, you'll wonder why it ever felt confusing. A bond is just a loan. That's it. Let's think of it this way. When someone needs money and someone else has it, they make a deal. The borrower says, "Give me money now, and I will pay you back later, and I will also give you a little extra for waiting." That little extra is interest. If you've ever lent money to a friend and expected to be paid back later, you already understand bonds. Bonds just turn that promise into something formal, predictable, and tradable. Now here's the idea everything else depends on. Money today is worth more than money tomorrow. If I have $1 today, I can use it. I can invest it. I can react to different opportunities. If I give that dollar away, I lose all of that flexibility. Interest exists to compensate for that loss. The longer you wait, the more compensation you usually want. The riskier the borrower, the more compensation you demand. That logic never changes. Now let's talk about who actually issues the bonds. Companies issue bonds to grow their business. Governments issue bonds to fund deficits, public spending, and major projects. Banks issue bonds to fund loans and keep the financial system running. And cities and public institutions issue bonds to build roads, schools, and public infrastructure. Governments spend constantly. For example, they spend a lot of money on defense, like military and national security. They also spend on things like infrastructure, healthcare, and on everyday things like social programs. Some of that spending helps productivity, which eventually leads to more tax revenue. But here's the key point. Governments almost always spend more than they collect in taxes. That yearly gap is called a budget deficit, and every time there's a deficit, the government has to borrow the difference. That borrowing adds to the total national debt, which is just the accumulation of all past borrowing. So, where does the government get the money? It borrows it from the public, by issuing bonds. When the government needs cash, it holds auctions and sells bonds to investors all over the world. Banks buy them, pension funds buy them, insurance companies buy them, foreign governments buy them, and even regular people buy them. Government bonds are considered some of the safest assets in the world. You get paid as long as the government keeps paying its bills. Now, every bond has the same basic parts. The principal is the amount borrowed. The coupon is the interest payment. And the maturity is how long the loan lasts. That's the entire bond. Now here's where things start to feel confusing if you've never seen it before. Bond prices can change, but the interest payment usually doesn't. Let's make this concrete. Imagine you buy a bond for $1,000. It pays $30 a year. That's a 3% coupon. A few months later, new bonds are issued that pay $50 a year on the same $1,000. Now ask yourself a simple question. Why would someone buy your bond paying $30 when they could buy a new one paying $50? They wouldn't. Unless your bond gets cheaper. So the price of your bond falls. The payment stays the same, but the price changes. This creates the most important relationship in the bond market. When bond prices go down, yields go up. When bond prices go up, yields go down. It's the same bond with the same payments, just a different price. Once that clicks, interest rate headlines stop feeling mysterious. Governments sell bonds on a regular schedule, weekly and monthly, across different maturities. This is called the primary market. The yield set at these auctions becomes a reference point for everything else. In the secondary market, investors constantly buy and sell existing bonds based on expectations. Investors are constantly trying to figure out whether inflation will rise, will the economy slow, and whether central banks will cut rates or raise them. Bond prices move based on what investors think the future will look like. That's why bonds don't just reflect the economy. They shape it. When bond yields rise, borrowing becomes more expensive. Mortgages cost more. Business loans cost more, and economic activity slows. When yields fall, borrowing becomes cheaper. Money moves more freely and risk-taking increases. Now let's connect this to stocks. Government bonds are considered the risk-free rate. They're not exciting, but they're predictable. Stocks are ownership. They come with uncertainty. So investors constantly compare the two. If bonds pay very little, investors are willing to take more risk in stocks. But if government bonds suddenly pay 5%, the question becomes whether taking stock risk is worth such a small extra return. That difference is called the equity risk premium. When bond yields rise, that premium shrinks, and when that happens, investors often rotate out of stocks. The same idea exists inside the bond market itself. Government bonds are safer. Corporate bonds are riskier. When fear rises, investors demand higher yields from companies. The gap between safe government bonds and risky corporate bonds is called the credit spread. When that spread widens, it's often a warning sign. Normally, long-term bonds pay more than short-term bonds, because locking money up longer has a higher cost. But sometimes that flips. Short-term yields rise above long-term yields. That's called an inverted yield curve. And when that happens, investors are saying something very specific. They expect slower growth or lower rates in the future. That's why inverted curves get so much attention. So bonds aren't complicated. They're loans that price time, risk, and expectations, and they quietly form the foundation of the entire financial system. Now, you don't just know what a bond is. You understand what it actually means in the real world. If this helped you understand bonds and how they really work, let me know what topic you want broken down next. I share more breakdowns like this on my channel, so if you want to keep learning how markets and money actually work, make sure to subscribe so you don't miss future videos. Thanks for watching, and I'll see you next time.